Right, welcome everyone. This is our second session of fourth season of Options Bootcamp. Uh, in the previous session, we talked about very basics of option contract. That was, if you've never traded options, you haven't heard about options. That was a session to attend. And then we also looked at put options. Today, we're gonna look at the other building block, which is called call options, and how we can use this call option to also generate consistent income. We will also look at some of the other uses of call options as well. Before we get into the session, please understand this. This is not a financial investment or tax advice. For that, you should talk to a professional. We are here to share knowledge with each other. We are here to enhance our education. So just take whatever you hear or you see, just take it as a piece of knowledge. Nothing more than that. For those who are attending here for the first time, I do see some couple of new names. Um, I'm not a full-time trader, or I'm not a professional trader. I haven't worked in hedge fund or any of the prop firms. I'm just a regular guy trying to provide a decent living for my family. In fact, most of my experience has been in technology industry. I've worked for more than 2 decades in software industry, around fintech and data management space. And then I also own a small business along with my better half in Bay Area for 7 years. I will be completing 8 years in a few months. My investing philosophy is I think about risk before rewards, because our money is a really hard earned money. We worked really hard to to have the money which we're now trying to invest. So I don't want to take a reckless risk on those. And I am focused on methodologies or trading mechanism that doesn't need me to babysit my portfolio. It could be different use case. If you are a full-time trader, you have a time to look at your portfolio for the whole day. That wasn't the case with me. I've been trading or investing alongside with my job, and there is no way I could have looked at I could have been hooked to my laptop for the whole day when the market is open. So I don't even focus on those type of trades or those type of methodologies. My way of investing is little different than you might have heard other people. So outside of these sessions, if you want to connect with me, you can connect with me on Twitter or on YouTube or on my website optiongig.com. You can email me or follow me with on Quora, ask me questions, or if you want to hear some of my thoughts while you're walking, a podcast is a good thing. So you can download podcast option gig if you want to s- still connect with me outside of this lecture. So let me just put the some links to this in the chat so that you have it handy just in case. Okay, quick housekeeping. We have these bootcamp sessions every Tuesday, and hopefully, I have already scheduled some of the future sessions on Meetup, but I will be adding few more sessions because in total we have 14 sessions. This is the second one, so we have total 14. Means you'll be here with me till July, and also we have a chat group for discussion on trades. Again, I would say a sample trades or a paper trades because I want to make sure that whatever we talk about in this meeting, we are able to implement it in a simulated environment or in a paper trading environment. So my idea is you should not just learn about the theory, but also figure out how to use it in the market environment. So with did share that in the last week and this week. So we on the Slack channel, we have a separate channel on the Slack group. We have a separate channel called BootCamp, wherein I did share couple of trades based on what we had already covered in bootcamp number 1. So if you have attended bootcamp number 1 and are wondering, okay, what's my next step? These are some of the samples that you could try. So I explain what the thought process is, then how you can frame a trade. Again, the idea is to enable you to think for yourself. But to take the first step, sometimes you need a little nudge or need a little help. So that's why I kind of figure out, okay, what's an opportunity, how we can frame a trade and share it in the bootcamp. So if you're not already on this and you're wondering, what's my next step after I've gone through this session? How do I find an opportunity or a trade that I can try on? Then maybe join the Slack group and look at the bootcamp channel. This is where I'll share. So here's a link for joining the Slack group. Also, the video recording will be uploaded on the website and will be available for viewing. It takes a couple of days, but I'll send a notification. And along with the course, I'll do a paper trading. And right now, I use Think or Swim trading platform because they also provide ability for paper trading. You could choose whatever platform that you are comfortable with or that you already have. I hopefully, if they have a paper trading or a simulated environment, that will be good for learning purposes. Hey, let's do a quick overview on the boot camp. Before that, any questions on any of these? I hope some of you who had attended the previous boot camp actually did some trades. Otherwise it'll be easy to forget all that we have learned if you're not using it for your if you're not doing any trade. Okay, all right, so quick overview. First session was about option contract, basic strategy on using put. We've already done. Today we're going to talk about call options and find out a way of how to generate consistent income using call options. We got 2 more sessions in the beginner section of the bootcamp. The next one will be talking about moneyness. You would have heard the term at money, out of money. And then we'll also do deep dive into how the exercise assignment process works. Then we move into intermediate sections. Sorry, one more, which is a checklist. Before you open an option trade, you should run a checklist through your mind. We'll talk about that. Then we will enter into what I call as an intermediate level of options. We'll figure out what are some of the strategies that you can use if you have a small value account. And number 6, I will actually take an account again in a simulated environment. We'll pick up $50,000, maybe $25,000. I haven't yet framed the account yet, and we'll actually create an options portfolio on the on that account. Then we'll talk about how to manage the trade and understand how the pricing works. Number 9, we will talk about how to exit a trade. So we will talk about entering a trade. There's a checklist for it. Then we'll also look at how to exit a trade properly. Then we'll move into what's called an advanced section. This is where we become more serious in terms of managing these or using these options as a real side business. It's no longer a hobby. It's no longer, yeah, maybe I'll make some extra money. If I don't make it, it's okay. It's just a pocket money. No, from number 10 onwards, it actually becomes a business. We'll figure out how to manage some of the option trades, how to understand the various factors that impact your options. Those are collectively referred as option Greeks. We'll look at how to use options for hedging your stock or individual stock or an overall portfolio. And lastly, for those who are retail investors, which is what I was and I had been, I want to also share some tips and tricks which might help in learning curve, as well as how do you save time during the day, or how do you figure out how do you find time to do the trades in middle of your working day. So we'll look at some tips and tricks as a last session. So in case if you have missed previous sessions, we have done only one till now, but if you had not attended that, you can go to the website, https://optiongig.com. So I see a question from on the chat. What's my website? So this is my website. You can go to website, register as a user, and if you all you want is just to look at the bootcamp videos, those are available free of cost. Just register as a basic free member. Go to the menu and to the bootcamp, and under the bootcamp, you already have a video for our first session. Go ahead and watch that video if you haven't done that yet. There are other things available on the website in case if you're interested on those, you can look at other membership. But if you're looking for bootcamp, just sign up as a basic member, you get access to it. All right, so I see a question. Can you share the site on YouTube for broker option approval? Again, one site on YouTube wasn't available anymore. But let me check that. So yeah, that was my next question is you had a homework from last session. First was to enable your account for options trading. I know a couple of you did not have options trading enabled. Hoping now you got it enabled. So to let me know, anyone who still don't have option trading enabled on your brokerage account. So if you have not, you should watch this video before you talk to your broker, so that you can answer some of the questions a little more intelligently. I did see a question saying this is not available, so let me check that. All right, so I do see this video. Let me just post this link once again on the chat. This is a little old video, but this is where I talked about how to answer some of those questions intelligently so that you can get the highest level of privilege. I see a question, do you have to get an approval for each level at a time? So generally, brokers will give you approval for the very basic one. And that depends upon how you answer some of the questions in their questionnaire. And that is why if you could go through that video, I've explained what are the factors that broker consider before they give you option privileges. But you won't get the highest level on day one. So you'll have to, so there are, depending on what brokerage firm you are dealing with, some have 5 level of option trading privileges, some have 4 levels. So you'll start with level 1 or level 2, or then as you add more capital, you get level 3. And as you have more experience, then they'll give you a little higher level. And depending on what level of option trading privilege you have, there are some strategies that you can do, and there are some that you cannot. That is why it is important that you try to get the highest level, whatever feasible, by negotiating with them. Even if you don't use some of those option trading strategies, it's good to have all the tools in our toolbox. We may not use it today, but at least we have it. And so that if when you want to use it, when you're ready to use it, you have the tools with you. The next part of homework was to find a company of which you would want to buy 100 shares. And instead of setting a limit buy order, sell a put option. Anyone did that? Just put it in the chat if you have sold a put option after the last week's session. Even if it is a paper trading, that's okay. Something that we learned, let's put that into practice. So these are the trades, two trades I shared. One was it sold a put option on BSC, which is Bank of America, sold one contract of it, expiring on 21st May, at a strike price of 38, and I collected 95 cents as a premium. When I did that, Bank of America was trading at 39. If you go back and look into Slack, my explanation was, I don't want to buy it at 39. I'll want to buy it at 38. So either I can put a limit order or I can sell a put. I actually sold a put, collected a premium of 95 cents. Again, this is a paper trade. So let's look at how that trade is doing right now. My recommendation would be don't go and follow these trades into your real trading environment, because I will pick up some trades which I want them to fail, so that we can also go back and figure out how do we manage it. And in a software terms, we do this as a negative testing, in which we will actually deliberately try to fail the system so that you can test it. Right now, we are all in a learning mode. So while some trades I will do is because I have that outlook. In some cases, I will probably do the reverse of it. So just don't go and blindly follow the trade and put in your for your real portfolio. If you want to do that, then I do share some of the trades which I do with the subscribers. So you might want to look at that option. But these are a paper trades from a learning perspective. So this is where we are. When I sold it, Bank of America was at 39. It had fallen down almost 3%. But our break even is far below. It's almost at $37.05. So we are still doing okay. We still got a lot of buffer in this one. Let's look at the next one. Was Roblox. Again, similar cash secured put. Roblox was trading at 73. I'm bullish on Roblox, but not at 73. But I'll be okay to buy this at 70. But instead of putting a limit order, went ahead and sold a put at 570. Let's look at how that is doing. Okay, the stock got a lot of beating. From 73, it is fallen down all the way to close to 69. But because of the premium that we have taken, our break even is way down. So as long as stock stays above $64.30, this trade will be profitable. So remember, stock was at 73. And now we got a lot of buffer for the stock to fall from 73 all the way to 64.30. Because we sold a put option, we got that premium, which gives us a buffer. So we are still okay with this trade. Nothing to be done, no need to manage. We still have a lot of buffer in this one. So I'll continue to hold. So these were the two trades that I shared from a learning perspective to be done on your paper trading or simulated environment. And then we'll see how this trade behaves throughout the market cycle. Let's move on. Before any questions? Okay, so let's get into the meat of today's session, which is talk about basics of call options, and then we will look at what are some of the option trading strategies that we can use using call options. So first, the very basics. So we talked about put option in our drill number 1. This is the second building block, which is a call option. Every complicated option trading strategy is built using the puts and the calls. So it is very important to understand how these basic option strategies work. Either you buy or you sell, because these are the Lego blocks. Consider when you get a Lego kit, these are the only two blocks you have. Now, using these two blocks, you can construct any complicated architectural monument. So it is very important to be extremely familiar with these two building blocks. So let's talk about what's the call option. Let's take an example from a real life. Susie had bought a house at $400,000 10 years ago, and now she is ready to sell it. She wants to put it on the market. Why not? Housing market is on fire. So Susie also wants to take an opportunity to sell the house. So Bob comes to her with a proposal. Bob wants to buy the house. So Bob says he is ready to buy the house at $500,000, but he doesn't have the money right now. I need a month to arrange the money. But Bob is also thinking, what if the house is not available after a month? So he enters into a contract with Susie. He pays $20,000 to Susie and tells Susie to take your house off the market. You keep this $20,000, remove it from MLS, remove it from Redfin or Zillow, and give me a right to buy this house at $500,000 within a month. Sound right? No rocket science here. Two people are entering into a transaction to buy a property. One is selling it, another one is buying it. The buyer doesn't have a money, so you're given some earnest money saying, hold the house for me for a month and I'll buy it at $500,000. If I don't buy it, you keep this $20,000 with you. What happens a month later? Say the market price becomes 530. So Bob, as a buyer, he's happy because he got a home at today. It's at 10K lower than from the today's price because he paid $20,000 as a upfront payment, not a payment, but he paid $20,000 to Susie to take the house off the market, and then he bought it at $500,000. So overall, the cost of buying the house for Bob is $520,000. But in the market, its price today is 530. So he's happy. Now Susie's total inflow, she was able to sell the house for $520,000. It's $20,000 higher than what the market price a month ago was. Anyway, she was looking to sell the house. She would have sold the house at $500,000 and got that money immediately. Instead, she was okay to wait for a month, got 20K upfront, and then got another $500,000 a month later. So her total inflow was 20K higher than what she was willing to sell it anyway. Let's look at other scenario. House could have gone down 30K. In that case, Bob probably will walk away from the deal. And he lost only 20K. He paid that earnest amount to Susie, and the deal was that if Bob doesn't buy the house at $500,000, Susie got to keep the 20K. So Bob will walk away. His overall loss is 20K. But if he had bought the house at $500,000 a month ago, or he would have been on a paper loss would have been 30K. What happens to Susie? She retains 20K. So the cost of owning the house is reduced. Remember, she bought the house at $400,000. Now this 20K is like a dividend payment for her. She got 20K. Her cost of owning the house is $480,000. Market recovers a bit. She can put it back at $500,000 and it'll be much more profitable. If the price doesn't change, or if the price goes up by 520,000, only $20,000, Bob can decide what he wants to do, whether he wants to buy it at $500,000 or not, because this is a break even for him. He already paid 20K. He has to pay more $500,000 additional to obtain the house. And in the market, he can sell the house for 520K. So that's it. It's a break even point for him. He can decide what he want to do. For Susie, she retains 20K. So if Bob doesn't buy the house, her cost is reduced by 20K. She can put the house back in the market. And her profit will be higher now because her cost of owning the house has been reduced. Why would they enter into this transaction? What Bob did? Bob paid 20K and he controlled an asset of 500K for a month. That's a typo here. And his maximum loss is limited to initial 20K paid. What if the housing market crash? If you would have bought it at 500K, housing market crash, it goes down to 200K. A month later, then the Bob would have been sitting at huge losses. In this case, he just paid 20K. And if market would have crashed, he could have just walked away from the deal. Why did Susie enter into this transaction? Because she got the money upfront to wait to sell at a price at which she was willing to sell it anyway. Today, the market price is $500,000. Susie wants to sell her house. She'll be putting the house in the market for $500,000. And now she got an opportunity, maybe wait a month and you get some 20K upfront. Yeah, I'll make another 20K. If it sells at $500,000, she was okay to sell it anyway. She may not have other buyers lined up. So it could have been a good deal. If there were other buyers clamoring for the house, like we are seeing in today's market, she probably would have asked a lot more than 20K. So net, both Susie and Bob had their own viewpoint of why they wanted to enter into this transaction. So why we're talking about houses? We are here to talk about option contract, right? So this transaction that we just witnessed is an example of a call option contract. In this transaction, Susie, she wrote a contract and Bob bought a contract. And that contract gave Bob a choice to buy the house at $500,000 within a month. But for this right, Bob actually paid 20K or a premium to Susie. So when you buy a call option contract, as a buyer, you have to pay a premium. So Bob paid a premium. As a call option writer or a seller, Susie received the premium of 20K. But Bob got a right to buy the house at a strike price for 1 month, which is the expiration period. So this is when we do the same thing in stocks or ETFs, that becomes a call option. So let's look at call option contract, what exactly it is. It's a contract that gives the buyer a right to buy the stock at a specified price within the specific time period. For this choice or for this right, the buyer pays a premium. Now, for the obligation that the call option seller, Susie, she has obligation to sell the house If Bob comes knocking at her door and say, here's $500,000, I'm able to arrange the money. Now give me the house. Susie has to sell the house. In this case, in case of a stock, option seller will have to sell the stock at the price that they agreed upon. In this case, it was $500,000. Whenever the option buyer choose to exercise his or her right. So there was a question earlier, can we exercise our option anytime or we have to wait until the expiration date? The answer is you can exercise it at any time. You may choose not to, that's a different matter, but you can exercise it at any time. So that was an example of a call option in a non-stock world. I just want to make sure that you are able to understand that we actually witness these transactions in our regular life. Now we will dive into the stock world and see what are the different elements of a call option contract. Before that, any questions, do let me know. I see one question already here. To do this trade, do we need the cash to buy the stocks if it is executed? Question from Sue. I think you're talking about the sample trades that we discussed. In those cases, yes. So let me put it that way. Today, I haven't talked about a margin accounts and all that stuff. So I will not answer a question from that perspective. Based on whatever we have learned till now, if you're starting off your option trading journey, you will have a privilege to do cash secured put. In that case, you will need to have that cash. It's similar to a limit order. If you are putting a limit order to buy a stock, your brokerage will hold that cash. You will not be able to do another limit order without having more cash. I am just using it as an example of, instead of putting a limit order, just replace it with selling a put. It is called cash secured put because you need to have that cash available in your account. 5 or 6 sessions, in the 7th or 8th session, I'll talk about how you can do this thing without even having a cash in your account. That's where we talk into the margin stuff and all, but I don't want to do that right now. We want to take baby steps and move on. How to close the call option. So if you bought a call option, just sell it back. These options trade depending on what type of, I'm assuming everyone is trading in stocks which are very liquid. So if you bought a call option, you close it. If you sold a call option, which I don't think you should do it if this is your first trade, naked call options, then you just buy it back. So remember, the whole cycle of a transactions have 2 legs: opening a transaction, closing a transaction. 99.5% of retail investors, I was one of them, I only knew one way to open a transaction, which is to buy a stock. So my opening transaction would always be buy, and how I close it? When I sell the stock. 0.5% retail investors or traders go the other way around, in which they actually short the shares. They don't own the stock, but they will sell it short. So their opening transaction would be selling, and the closing would be to buy it back. Same thing we can do in options. If you have sold a put, you can close the transaction by buying it back. If you bought a call or bought a put, you can close it by selling it. So Daniel, I hope that answers your question. How to close the call options? Just sell it. Sorry, yeah. If you bought it, just sell it. If you have sold it, just buy it back. What is the risk reward in this case? So Prasad, can you specify what case? Are you talking about the call option or the example of Susie and Bob? I'll get more details in this one in terms of call options, and if you're selling a call option or if you're buying a call option, what's your P&L, etc. Yeah, so we'll get into further details. I'm not done on the call options yet, so just hang on. So let's look at the main elements of any call option contract. You have a stock on which you want to do a call option. Same thing, we had a put. We had a stock. Took an example of two of them, Bank of America and Roblox. In this case, let's say it's a Snap as a ticker. How many shares are included in one contract? Most of the time it is 100. Not gonna talk about exceptional cases. Date of expiration, 21st May. Strike price, 60. Consideration amount or a premium is $5.50. Just an example. In the case of Susie and Bob, the thing or the asset was a house, one house. Expiration was 1 month later. Strike price was 500,000, and the consideration or a premium amount was 20,000. If you look into your trading platform, this is what I was referring to. You got a Snap. Left hand side is your call options. This is your strike prices. In the center, you got a 60 strike price. You're being sold for say 550. Expiration date is 21st May 2021. So these are the very basic elements of a call option contract. So let's talk about exercise versus assignment. I kind of already discussed that during the quiz, that buyer has a right to exercise the contract, and option seller will be assigned the contract. If it is not exercised by the buyer, the contract will expire worthless. The first or the second question was, is it mandatory to exercise it? No, it is not. If as a buyer you don't exercise it, the option will expire worthless. And the seller will retain the full amount. Now let's look at what happens if you buy a call or a sell call, because these are the two operations that we can do on any options. Either you buy it or you sell it. So let's look at buying call, also known as long call. So if you're buying a call contract, if you are buying a call contract, it gives you, the buyer of call option contract, a right to buy the stock from the seller. In our housing example, the buyer was Bob. Bob got a right to buy the house. You will get a right to buy the stock at the price that is specified in an option contract, which is called as strike price. Anytime on or before the expiration of the contract. You don't have to wait till the expiration date. Don't have to wait till the last date. If you want to, you can exercise it tomorrow. But again, I'm only talking about American type options, which is what most of the options that are traded on US exchanges are. There are European type also. Let's not get into that right now. For this right, you pay a premium to the call option seller. Bob paid a premium of 20K. In Snap, we looked at, that was a premium of $5.50. So if we look at that Snap example, in which you bought a call option contract at a strike price of, this is strike price of $60. You paid premium of $5.50. That means your break-even point. Break-even point is a point in this case, the stock has to go beyond break-even point at expiration to make any money. So this red line that you see is an expiration profit and loss diagram. So you already paid $5.50 to enter into this contract. So if Snap on 21st May is below 65.50, you're not making any money in this trade, because you got yourself a right to buy it at 60. And if you're going to sell it in the market price is 65.50, you're not made any money because you paid $5.50 to enter into this contract or to buy the right to get a stock at 60. If a stock goes beyond 65.50, that's where your profit starts to come in. So this is $0, no profit, no loss. Stock is beyond 650. You see the red line going up. Now your maximum loss, say the stock goes down to 50. Your loss is what you paid, which is $5.50. So your loss is capped at $5.50, irrespective of wherever the stock might go. So this is your break-even point. This is how you calculate a break-even point if you are buying a long call option. Always add the premium on the strike price. So your break-even point will be your strike price plus the amount of premium that you have paid. So stock has to work to go beyond this total to make money for you at expiration. Before expiration, if a stock immediately goes higher, even if it is not at 65.50, it will still make money for you. So say you entered into this contract around 419, when stock was at 60, and by evening, it actually goes to 63. Your contract will be profitable. But if it stays and gets stuck at 63 for till 21st May, then this is not profitable for you. So this is your P&L profile for a long call option. In this case, break even is strike price plus the amount of premium that you have paid. Stock has to work more to make this a profitable deal. What are the reasons one would buy a call? Call exists. So, and people do buy it. So the reason is to express bullish sentiment on a stock. I'm not saying that this is right or a wrong way, but this is a way to be bullish on a stock. If you were bullish on Snap, and if you think Snap could go to 90, could go to 70 by May 20, at the end of May 21st. So instead of buying 100 shares for which you'll have to pay $6,000, you may want to buy a call option. Means you're investing only $550. And if it goes to 70, you'll make $450. So making $450 on an investment of $550, pretty good deal. And if a stock falls down from 60, it goes to 50, you have only $550 at risk. So if you're bullish, people buy call. Again, I'm not saying that is that the only way or the optimal way, but it is a way to express bullish sentiment. Or as you progress more in your option trading journey, you realize that why do I even want to hold a stock in my portfolio? If stock is not paying any dividend to you, then you can actually replicate the same behavior by having a call option. From a capital efficiency perspective, that will be much optimal way of doing it. So a little more advanced. investors or traders, they'll substitute the stock with a more capital friendly call option. So these are a couple of reasons why people will buy call options. So let's get back to our box, put call box that we started in our first session, and add it here on the call buy. If you buy a call, means you are bullish. Whether you are substituting it for a stock or you are just buying a call without having any stocks. If you buy a call, you want the stock to go higher. It means you have a bullish outlook towards that underlying. Okay. So if you had that box, someone had asked me in a previous boot camp, how do you remember? And it was a challenge for me as well. But this is how I remembered. I had a post-it on which I'd put this box. So I know if I buy a put, it's bearish. If you sell a put, it becomes bullish. If you buy a call, it becomes bullish. We'll talk about what happens if you sell a call. So let's look into that. Before that, let me address some of the questions. How do you ensure that you buy back your specific call option? You go back. Let me answer the lens question. Say, I have now sold this when I did that paper trade. This is a paper trading account. Now, all my options, depending on what platform you're on, I could just go back and this is what I had sold at 38. I'll come and say, no, buy. Now I'm buying it back. So when I buy this back, it will close out my exit, the earlier position. That is one way. You can look at that. I already have a position here. I'll buy it back to close this. Other way, Thinkorswim does is you can come back to this option, right click and say create closing order. It created a closing order. Oh, I went to Roblox. Okay, so I was taking an example of Bank of America, now back on Roblox. So I create a closing order, confirm and send. And when this get executed, this will close my option. So it doesn't matter whether it's a buy or it's a call or a put. You can just go back and close that option. Let me cancel it. Okay. Next question. If you sold a call and now want to buy to close, as long as the premium you have to pay to buy is less than the premium that was paid to you, you're profitable, right? Yes. Asif, yes. So if you've sold a call, you received $5 as a premium. And that's happened with many times, either stock goes down or stock does nothing, but your premium is decayed because of theta effect. Or you could buy back the call and close your trade and just take the profits home. As you'll advance, you'll realize I do mostly those trades. I don't have no intention of holding the stock. If it is not a part of my core strategy, I'll do it purely from option trading perspective is sell an option and buy it back when it is profitable. Another question. After break even, how much will we get a profit? That means for $1 increase, we will get $100. We'll talk about it because we haven't yet looked at the delta. So it depends on how far the stock has gone. So let's go back to maybe without even talking about those deltas. Say if I can simulate the same stuff. So we wanted to buy Snap at 60. Okay, this has decreased from yesterday, say 550. This was example. This is P&L diagram. Is 650. Now, if a stock goes down to say 670 at expiration, which is a teal color, you're making 150. At that point of time, this is 1:1. But it may not happen always 1:1 because It depends on, um, sorry, let me also look at the questions. After break even, how much will we get a profit? At expiration, it is 1:1. Before expiration, it depends on the other factors, which will determine how far in the money is your option is. We haven't talked about in the money concepts yet. We haven't talked about deltas yet. That's why I don't want to get into the details of that. But near expiration, it is 1:1. Means for every $1 rise, you'll get close to 100 because the delta is close to 100 at that point of a time. Another question is, in selling put option, it required margin value. In this case, do we require any margin? I'm not sure if I understand your question. If you're selling a put option and if your account do not have a margin privileges, then you need to make sure you have enough cash. So if I'm selling a put option on Snap, instead of buying a call, if I'm selling a put, I need to make sure that I have $6,000 in my account. Now, if you don't have $6,000 and you don't have margin privileges, your brokerage will not allow you to sell this option. Okay. All right. Any other questions? All right. So let's look at the other stuff. Instead of buying it, how about selling a call option or short call? So what happens when you're selling a call contract? Now we switch the places. When you sell a call option contract, you become Susie. You're giving a right to someone else. You're giving a right to Bob to call the house or call the shares from you. But when you sell a call option contract, you take on an obligation to sell the shares whenever they are called from you. Whenever Bob comes knocking on your door saying, I want this house, as a Susie, I have to sell the house. Similarly, whenever any call option buyer exercise their right to buy the stock, I have to sell the stock. So by selling a call option, I'm giving a call option buyer a right to call the share or to buy the shares from me at the price which we have specified in an option contract, also known as the strike price, anytime on or before the expiration of that contract. It is important to understand. And sometimes even I'm surprised that sometimes I get assigned a few weeks before expiration. We'll talk about those stuff, early assignment risk and all that. Most of the time, the assignment will happen in the last week of expiration. But I have had cases in which I was assigned 3 weeks before expiration. Because technically, buyer could choose to exercise their right anytime. 3 weeks, 4 weeks, it's up to the buyer's prerogative. But for giving away this right and taking on this obligation, you receive a premium of $20,000 if you are entering into a call option on your house, or if you have sold a call option on the Snap shares that you hold, you got $550 for one contract. Now, when we'll talk about selling a call, there are two flavors. One is called naked call. It means selling a call without having shares. Remember, I talked about 99. I talked about 0.5% retail investors or traders who sell the shares without having the shares. That's called short selling. In options, same thing exists. You can sell a call without having a shares in your portfolio. You are giving someone else a right to buy the shares from you, but you don't even have a shares in your portfolio. So this is called naked call. This is available only if you have the highest level of option trading privilege. Just like short selling, it's got an undefined or unlimited risk. Naked call could lead to huge losses if you don't know how to manage properly. That's the reason why they don't even offer naked call privilege if you are just starting your option trading journey. This is available only in level 4 or level 5, depending on which brokerage firm you are with and what's their highest level of option trading. I have read many horror stories. In some cases, the hedge funds who went belly up because they had sold too many of the naked calls. So this is for information only. We shouldn't do it if you're just starting your option trading journey. And your broker won't even allow you to do it unless you have a big account value or you have negotiated after trading for some time for a highest level of option trading privilege. The other flavor is called covered call. Now this was naked. Reason because your call options did not have a shares. A covered call is selling a call while you have a shares in your portfolio to cover up. In case Bob comes knocking on your door, you have a shares to hand it over to Bob. In this case, you have no shares. If someone exercises it, the buyer exercises it, you will have to buy the shares from the market and deliver it. In this case, you actually own the shares. So irrespective of where the market goes, if you are assigned this call contract, you're covered. That's why it is called covered call. Any questions on these two, covered call or a naked call? In the remaining 35 minutes, we're going to go deep into covered call and look at how we can use it to generate consistent income, how we can use it to do better than putting a limit sell order. That's our next part. Before that, any questions on calls? So very basics of call options. Okay, looks like no more questions. So let me move on to the next section. Okay, I see a question saying, is the premium same for covered and naked calls? Yes, the premium is same. The reason is right now, let's say if I have, okay, let's convert it to a call option. Instead of selling a put, I'm selling a call. Okay, let's watch it in real time. Here I've sold a call. It was 550 or whatever, it is 490. Here I've sold a call. Now, if you look at my portfolio stock, I have 0 stocks of Snap. Now, the reason why brokerage firm won't allow you to do this is, what if Snap goes to 100? I'll be losing like $3,500. What if Facebook decides to buy Snap and willing to pay 150? I don't know why, but let's assume I have a probability or possibility of extreme losses. So that is why they don't give this privilege to new option traders. And that is why I've seen some horror stories of people selling call without understanding the implications of selling calls. Let's add 100 shares. That's the beauty of this paper trading platform, is I can do this without messing up with my real portfolio. So let's analyze this trade. Now I got 100 shares and I sold a call. Now if a stock goes high, I don't end into that risk because my call is covered by the stock. If I continue to go high here, there is a possibility of unlimited risk. Here it is covered by the stock. But the premium, whether you buy or sell, is the difference between bid or ask. If I buy it today, I buy a $60 call, I'll have to pay $4.95. If I click on a bid, this becomes sell. I'll basically receive a premium of $4.90. So there is no difference on the only difference is what is in the bid or ask, like you have on shares. Otherwise, there is no difference. Okay, see another question. Do you prefer to sell covered calls only if your cost basis is not too low from the stock price? If my cost basis is say 50 to 100% lower than the strike price, I don't want to lose them. So we'll talk about it. Let's park this question so that I'll talk about it in the covered call section. There are different strategies on how and when you want to sell a covered call. So Asif, just hold on. Okay. So Prasad, I hope you had a question on risk and reward on a call option. Do you still have that question or is that clear now? Do let me know if you have further question. Okay. Let's jump into the second part of our today's session. Looks like we may run a little bit over, but let's see. So this option trading strategy is called covered call. Again, when I started the session, I said there are two newbie strategies we will talk about. And when I say newbie, I'm assuming you have never done options. All you have done is a limit buy and limit sell. Now I'm just trying to give another way, which may be more optimal than limit buy and limit sell. We looked at cash secured put and say maybe instead of doing a limit buy, you could do a cash secured put. This one, covered call, is we'll talk about it that instead of using limit sell, how you can make use of covered call. So that is why I call it a newbie strategy, because it is easy to understand as a stock, as a purely stock, an ETF investor or a trader. Now I can move over into the option world through this strategy. So let's first understand what's the motive that we are trying to achieve here. I'm an investor holding shares in my portfolio. Maybe I got those shares as a company stock options. Maybe those are the shares that I bought a few years ago. Maybe my rich uncle gave me those shares in his will. I don't care what the source of the shares are. The fact is that I have shares in my portfolio. So first motive is I want to sell the shares, but not at a market price. I want a better price than the market. Other motive we will look is I'm long-term bullish. So I don't want to sell the shares. I want to hold my shares, but I want to generate some income out of those shares. And specifically, as I mentioned, most of you are in the technology sector. Many companies give stock options. You're working in that company, you're bullish on it, but those stock options are lying in your account, not doing anything. If it's a growth company, it doesn't even give dividend. So second motive we will look into is how do we use call option to generate some income? Motive first. I bought a shares of Snap at 55. Current market price is 58. I want to sell it, but not at 58. I want better price. I want 65. So I'll put a limit order at 65. This is what we have done for years. And then wait and watch, wait and watch. Or the other choice you have is to sell a call option at 65. You can decide you want to wait for 30 days, wait till May 21st, which is close to 30 days. And you receive a premium of $3, which is actually more than $3, but I put $3 is easy math for me in the subsequent slides. So if you sell a call option right now, you might get around 327, 328. This is Snap shares. We're talking about call options, 21st May, 31 days out. I'm okay to sell it at 65. So I choose this 65 as a strike price. If I sell this, minimum I'll get is 320. For calculation perspective, let's assume it is $3. Okay. So this is the trade setup. Let's see how this setup behaves. Say in next 30 days, stock has gone up, down, haven't moved much, and stayed close to where it was when I opened the trade. If I'd sold a limit order, if I'd put a limit order at 65, I still hold my 100 shares. Stocks haven't been sold because it didn't hit the limit price. I'm not compensated for the time, for the 30 days that I've been waiting. So cost of owning the shares is still 55. I bought these shares at 55. And now I'm trying to sell it at 65. I want to make some money. Return on capital, 0%. No sale, no return on capital. Let's look at the other side. I sold a call option at 65. Stock at expiration was at 58. The call option buyer will not exercise. So this will expire worthless. If the option is not exercised, it expires worthless. Means no one will call my stock away from me. I will still have 100 shares in my portfolio. But I got a $3 premium. That is also mine to keep. That I got it today when I sold a call option. So this reduced the cost of owning the stock. This is not an IRS cost basis from a taxation perspective. But imagine you bought something at 55 and then you got $3 dividend. Kind of your cost basis has been reduced by those $3. So your new cost basis is 52. Your stock is at 58. You kind of made you made $3 on $55 stock. Decent 5.4% return in 30 days. And you still hold the stock. So net, you got $300 on $5,500 investment. Even if the stock hasn't done nothing, stock hasn't moved. Let's look at other scenario. Stock can go up, stock can go down. Stock goes down to 53 from 58. Now it is down by $5. If you put a limit order, stock is not sold. It hasn't hit 65. You're not compensated for time. Your cost basis still remains 55. So your loss is $2 because now the stock is at 53. You bought a stock at 55. Your portfolio or your Snap shares is losing $2 per share, which is loss of 3.6%. Instead, let's look at what would have happened if you had sold the call option. Those $3 that you got, that's yours to keep. So your cost basis, as we looked into the previous slide, is 52. You are still profitable because the stock today it has 53, but you got $3 as a premium, which acted as a buffer. So as long as stock doesn't fall by more than $3 below your purchase price, it's still a good deal for you. So you're still profitable. Return on capital is close to 2%. But the fact is that stock fell down below the cost basis, but we are still profitable. Third scenario, it hits the target of 65. Today it has 58. In next 30 days, it goes to 65, expires there. What happens if you had a limit sell order? Stock is sold at 65. Your cost was 55. Profit is $10. Congratulations, made almost 18%. It's a good deal. You sell a call option at 55. Stock will be called away at sell a call option at 65 because that's where you sold your call contract. Stock will be taken away from you at 65. Your cost basis is not cost basis, but initial price at which you bought the stock was 55. Overall profit is $10 is the difference, plus $3 is the premium that you received. So overall profit is $13. So if you had sold a call option, your gains are amplified. As long as it has 65, it's all good. This is your strike price. Let's take an example that it even goes beyond your strike price. Mark Zuckerberg has decided to buy Snap. If you had limit sell order, no change. The moment it hits 65, your limit sell order will get executed at 65. Not a bad deal though. It'll still make 18.2%. If you had sold a call option, no change there as well. In both the cases, your gains are capped at the price at which either you put a limit order or you sold a call option. Now let me look at any questions. So this is important to understand various scenarios and how these work, and if stock goes up, down, etc. Now, as if you're looking at a limit order and you're okay to wait, you might want to then sell a call option instead of putting a limit order and get some money up front. Okay, let me address one question. During corrections, such as now for growth stocks, are premium lower for calls than they are during the general market uptrend? So the premium depends on many factors. One is what's your strike price. Then there are a lot of other external factors like what's the implied volatility, etc., etc. Generally, if I consider that the strike price is the same, let's take an example over here. Say if the stock is at 58 and if the market is showing going downturn or there's a risk in the market, the premium for a call will be higher than in a scenario where the stock is at 58, but the risk in the market is less and the market is looking to move up. Because more is the risk in the market, implied risk in the market, more is the amount of a premium. We are now getting into how the option pricing is determined. We'll talk more details on how this premium value is impacted. So one of the factors is what's the risk what's the implied, what is market participants are implying in terms of the overall risk. If they are a little jittery, they think that there's more risk in the market, the premiums will go higher. Next question. Can I rewatch these sessions? If so, where can I watch and when? So I talked about it when I started the session. Maybe you missed that slide. So So that is available on the website. Let me see if I already have logged into it. Yes. So if you go to website option gig, you can come to members and look at a boot camp. So I generally upload these by end of Thursday. So if you go to this page, bootcamp page, you will see today's session available by Friday morning. So if you want to refresh it, or if you have missed any session, make sure to go through it before you come for the next session, because we always build upon the previous ones. Okay. All right, the next one. What if the stock get the dividend? Are we eligible to get that dividend? Good question. So if the stock is giving you a dividend, as long as you hold the stock, you'll get a dividend. Call, if you just hold a call option, you're not eligible for dividend. So if you are a dividend player, and if you want to have a consistent income, and if you want to hold a dividend paying stock, then you need to hold the stock. Call options don't give you dividends. But we will talk about, if the company is not giving dividend, how do we create our own dividend? So let's look at any other question before I look at a motive 2. So the other motive for someone who is holding, okay, I see one question. Let me address that. For Snap, there seems to be calls at below current price. What does that mean? There will be call options on multiple strike prices. So remember, one of a reason I gave why people would want to buy call is to do a stock substitution at a more capital efficient way. If I were to do it, I would rather go and buy this call. So that is why you have the call option listed at multiple strike prices. If I'm holding a shares, Snap doesn't pay dividend. Holding 100 shares cost me $58, $5,800. I might want to sell that and do a buy this call, which could, let's get rid of the other ones, potentially behave equivalent of how the stock would behave. So let's look at if I have this 100 stock, I buy it at today's price, or 58.60. Look, not 85, 58.60. This is my P&L graph. Stock goes above 58.60, I make $1 for every $1 rise. I might want to substitute it with this. Stock goes higher, I'm making almost equivalent of it. And I don't have to pay 58.60, I have to pay 34.65. So this is sometimes called, this is called stock substitution. I see, but the buyer may not decide to exercise immediately upon buying the call, is it? No, I mean, it depends on buyer. I would not. I would want it to participate. If I'm holding this call option and the stock goes higher, if I want to take a profit here, I'll just sell the call option back. I mean, I don't want to go through the exercise process. I'll just sell the call back and just make my money. And if I'm still interested in stock, I'll probably do another bullish strategy. Okay. All right, let's look at the other motive, which is holding. I'm holding a stock. I work in this company. I'm long-term bullish, but my company doesn't pay dividend. And I have a bunch of stock options. How do I make use of that stock option that are stuck? I want to generate some regular income, but I don't want to sell the shares. So let's look at a few strategies around this. If you have a stock in portfolio and you like to hold it, but want to generate some income, maybe sell a call against it. Again, this is becomes a covered call. But the difference here is instead of choosing 65, say Snap, instead of choosing 65, I'll pick up a strike price which is way far away. In case if we have a momentum stock, Snap could be considered as one of them. So if I have 200 shares of Snap, I may only sell one call option. Or call spread, we'll talk about that later. Do it every expiration period. So when you sell a call option, you get a premium. And we'll look at a screen in which I'll go ahead and sell a call option on Snap at $80. When I bought it at 55, I'll sell a call option at $80. I will be able to collect some premium. So there's a question, what's the momentum stock? Momentum stocks are the ones which generally either run up too high too soon or fall down too quick. There's a lot of participants, or there's a lot of momentum behind those stocks. So many of these high growth, or not high growth, the new age companies, a lot of EV companies, a lot of companies in tech sectors, in which you will see sudden sudden movement in the upside or on the downside. Those are called momentum stocks. So the reason why this line I added only in 2020, I did not have this earlier, but not every year is like 2020. But if you have, say, in case of a Snap, if I had 200 shares of Snap and I sell a call option on both of them at $90, which is still very far away. But if Snap is a one big momentum stock that goes up 20%, 30%, I don't want to have a remorse that, oh, I sold it cheaply, I should have held on to it. So in that case, if I have those stocks in my portfolio, maybe I sell it only on portion of my long holdings so that I can still enjoy if it becomes 100% in next 30 days. That's why if you're holding momentum stock, instead of not doing anything, maybe do it on a portion of a long holdings. So going back, looking at Snap, the previous example we took, I sold a call option as a covered call at 65 because this is, I want to sell the stock, but not at 58, which is current market price. I want to get a little more for my trade. I want to sell it at 65. That was my covered call trade. This is kind of also covered, but here my motive is different. I work in Snap. I know that this company in the long term will do good, but short term will go up 10%, 20%, but it stays in that range. So how do I generate any income from it? If I look at a Snap, if I sell a covered call at 75, I'll be able to collect $1.35. Now my shares will be called away only an expiration if the stock is beyond 75. So remember, I bought my shares at 55. If it be called away at 75, I didn't want to sell it, but I think if it called away at 75, I won't feel too bad about it. Okay, if you think you'll have a seller remorse at 75, maybe go and sell it at 85. Collect 60 cents. 60 cents on a $55 cost basis is around, that makes it what, 3%? Oh, sorry, 1.2%. 1.2%. And if it goes all the way to 85, you made $30 on top of it. So pick up the strike price at which you won't have a seller remorse. Go far down and then try to sell a call. I mean, don't sell a call at 10 cents or 5 cents or 15 cents. The reason is you're limiting your gain. If you're selling at 80, you're limiting your gain from 55 all the way to 80. For $1, that's a risk that is worth taking. But for 5 cents, that's not really, doesn't really make sense. So this is, if you do it once, do it another time. Let's go back to the trading platform. Snap. I sell it here. Okay. Snap results were good. I think it's announcing results sometime this week. It went all the way up to 65, 70. It's okay. Didn't hit 80. I retain 90 cents. Later on, I might well sell it for June. I'll go ahead and sell it for June at 85. Or if the share is at 65, then I might sell it at 100 and collect some more premium. So if you're holding a stock, this is one way of generating an income, creating your own income stream. And more importantly, every time you collect this income, it reduces your cost basis. So I have many stocks in my portfolio in which when I bought the shares, I bought it at, let's say, $20. Now my cost basis is $10. And I still hold the shares. So by doing this, I gave myself buffer that even if stock falls down by 50%, I'll still be okay. So then you don't have to always worry too much about the stocks. If you can create your own way to reduce the cost basis. Okay, let me address some questions. Oh, I see a question. Do you wait for it to expire worthless or do you close it anyway for income trade? So when we talk about trade exit strategy, I will get into details of when I close it. But because you asked this question, if I've sold it at 75 and currently it is at, I'll be able to sell it at $35. Stock doesn't do much, stock doesn't go high, or if it goes high, it goes slowly. In another 10 days, if it decreases, the value of this goes down to approximately 50 cents, I will close this trade. So net, I will make 85 cents on this one. And then immediately I will go and sell another covered call for a longer duration. So lens is, even if it got called away at 75, you sell put to reacquire and restart the cycle. Absolutely. This is what called as a wheel strategy. I actually did a video on wheel, is how you start to acquire your shares. You sell a put. If it get assigned, you got the shares. Then you sell a call. Keep selling calls. If you get assigned, shares are taken away. You are still bullish on the shares. Sell a put again. Just keep going through this wheel and keep collecting income. Let's look at some of the rookie mistakes that I have seen in 2020. Some of my folks that I know have done, and I learned from them as well. Number one, I see people doing mistake is that they buy the stock to sell the calls. Now, there was a question on when the premium is high When the premium is generally high when the market perceives that there will be more risk of either going high, the stock could make lot more movements. When the implied movement in the stock is higher, when the market thinks that the stock could move violently, the premium will be high. So one rookie mistake is people get attracted towards the premium and forget about the stock. So let's take an example of some these high flyers. Let's look at Fubo. Now for $17.50, if I sell a call on 17.50, I can collect $3.55 as a premium. That is 355, 20%. So what some of the rookie mistakes I've seen is people could buy the shares. Today it is trading at $18. We'll buy 100 shares and sell a call at 17.50 or say 20. Think, I got a lot of buffer in here. I buy the shares at 18 and I sell a call. I'm on the June. That's fine. So I'm sell a call at 20 for next 60 days. I'm collecting like 10%, more than 10% of the strike price. I said this as a rookie mistake because you haven't studied Fubo. The premium is high for a reason. So don't buy the stock because you want to sell the covered call. Do it reverse. Because you have a stock in your portfolio, because you want to hold the stock, that's why I want to sell a covered call so that I can reduce my cost basis. Mistake number 2 or kind of related is we focus more on a call option than the stock. But remember, this option premium is a gravy. The meat is the stock. So make sure you want to get married to Fubo. Make sure you like Fubo as a stock before you want to buy the shares because you want to sell a covered call because the premium is so rich. Most of the risk in the trade is coming from the stock position, not from your call position. Which I've seen people ignoring it. And then what happens? Fubo goes down to $10 and you're like, gosh, my portfolio is losing money. Could happen. So if I'm long-term bullish on Fubo and Fubo goes down to $10, I probably will still hold. I may not feel bad. I probably will be feeling better because now I can buy Fubo at a lower price. But if you have not done your analysis on stock, but you got into this option trade because you were enticed by the big premium, that's a rookie mistake. Other one is get too big on a stock position to capture large premium. One contract gave me $2.60. I can get $1,000 if I do 4 of these. Let's buy 400 stocks, shares of Fubo so that I can sell 4 contracts. Don't do that. Or if you already have shares, say you already have Fubo or any other shares, you have 200 or 400 shares of that. Don't sell everything, don't sell a covered call only at a 1 strike price. Maybe give yourself a little more room and give your trade, don't hold your upside on just 1 strike price. Remember, if you hold a shares and then you're selling a call, you're limiting that upside, right? We looked into this example. If I hold 100 shares and let me add this and I already had it. And if its shares go high, I make 1:1. If I sell a call option, I sold a call option at say 75 or 80. I am limiting my profit after 80. If the stock goes to 100, I don't participate in any growth after 80. So if I have, instead of 100, if I have 400 shares, I won't just do everything at 80. Maybe I'll add one at 80. Maybe you'll do another one at 90, 85, so that if stock really becomes crazy, I don't limit my upside at just 80. I'll just spread at a different strike prices. Lastly, please remember that the stock position is what will impact this overall portfolio the most. Don't forget the stock. I know everyone gets excited about, I can get this big premium, but make sure you look at your stock. Make sure you love the stock more than you like the premium from a call option. Otherwise, you may be holding a stock that you don't like, but it brought some call premium, so kind of a merit to it. And now the stock didn't work out the way you thought it would, and then you hate the stock. So do this only on the stocks that you want to continue to hold in your portfolio. If you don't like stock, get out from the stock. Other thing to watch is watch out for dividends. If Snap doesn't pay dividends, so it's okay. Later on, we'll talk about it, why I'm asking you to watch out for dividend. It brings a risk of early assignment. And keep an eye on earnings. Reason? Stocks could make violent move after earnings. So if Snap is reporting results tomorrow, then I don't want to sell any covered call at, let's say, 60 for tomorrow. So 23rd April. Then I might want to go further away because it could make a big violent move. I think with this, I'm at the end of today's session. Oh, we ran 5 minutes over. So thank you for staying along. Now I will answer some of the questions that I see here. If anything I had missed out, I'll go to those Q&A. Otherwise, we are done for today. Yep. Last takeaways is use covered call to sell stock at a higher than market price instead of limit order. You can also use it to generate consistent income stream and reduce your cost basis. You may not feel that if you've done it once or twice, what's the point? I'm only reduced like 2%. But believe me, if you do it consistent enough, I hold some shares in which my cost basis itself has gone negative because I collected more premium than the amount of the money I spent on initially buying the stock. Because I'm doing it for a couple of years now. And I want to hold that stock in my portfolio. And the stock has gone up and down, it's gone all places. But I have my long-term thesis on the stock. I don't want to get rid of that stock. It doesn't pay dividend. Sell covered call on those. This becomes equivalent to earning regular dividend on the shares that you own in your portfolio. This is bullish. I still want the stock to go higher because I have a lot of stock in my portfolio. So I want it to go higher. Even if it gets called away, it's okay. Overall, I'll still make money. Lastly, understand that your portfolio is impacted more by stock than your call option. Keep an eye on your stock. Keep your analysis on the stock before you sell a call to capture the premium. Make sure you love the stock. A quick homework. If you have not done it, enable option trading in your account. Sell a cash secured put on the stock that you won't mind owning. If you don't have a paper trading, then you have to do your own study on this one. If you have a paper trading, I started sharing some of ideas. Some of them could be just from a testing perspective in the boot camp. You could use those. If you want real trades that are also available on the website. If you have existing shares, sell a covered call against it. Pick up whatever strike price you may be okay to let your shares go. Pick up something 20% higher for next 30 days. Just try it out in a simulated environment. Doesn't hurt. If you have 200, 300, 400 shares, maybe do on only 2 contracts. So that if that company is being acquired, you still have some shares to participate in the huge upside later on. All right, now this is the end of our session. So let me address some of the questions. For others who don't have any questions, if you want to drop off, please. I really appreciate you guys stayed over 7 minutes more than the scheduled time. I'll try to do better next week. All right, let me address some of the questions now. There is one question was from Asif. Do you prefer sell covered calls only if your cost base is not too low from the strike price? If my cost base is say 50, 100% lower than the strike, I don't want to lose it. No, so I sell covered calls depending on where the current stock price is. So if my cost base is, like I was talking about some shares in which my cost base is actually negative, but the stock is trading at $20, I will still go ahead and sell a covered call at, say, $30. As long as I don't have concerns around tax implications. Yeah, that's something which you should understand is if you're selling a call, your share gets called away, that will be a taxable event. Another question, can you show me how to see open trades on option gig? So open trades are available for those. Let me put it. So I do share my trades for those who are helping me to run this website at a nominal charge of $20 per month. So you get to see the open trades plus all the Saturday weekly webinars plus the trades when I do it. Those are also available under this trade section. So if you are basic free members, you will be able to see the trades, but those are at least a month old. So if you are a pro member, you will be able to see, for example, the trades that I did today. We closed one straddle on FXI. Stock didn't do anything. Stock was like moved only 0.3% in last 20 days. So worked out well. We opened one position today. I also closed another Twitter trade, made some bunch of money. So these trades are available immediately as an SMS and email and on the website. Similarly, the open trades will, if this is still there or not. So I still have a few open trades on this one, but these are available to the pro members. Cool. Any other questions? Well, thank you, everyone. Let's talk on Saturday if you're attending Saturday's session. Otherwise, we'll talk to you again on next Tuesday. Please do the homework. And if you've not seen if you want to refresh the concepts, go and rewatch this video. It will help you in your journey because I will continue to move towards session number 14. And if you're still thinking, how do I sell option or what was the basics of put and call, it won't be beneficial for you. All right.